The last time I shared this trading strategy, my video got yanked off the internet with zero explanation. Now, I'm not going to go all ICT on you and spin up some conspiracy, but honestly, they gave me no explanation as to why it was yanked, and I know for a fact I didn't do anything wrong. So, I'm posting it again, and fingers crossed, it stays up this time. So in this video, I'm gonna share the strategy again. I'm gonna share my entire setup, the prop firm I use, and how I use them to leverage risk. Obviously, my results aren't typical, but I'm giving you everything that I use and did in order to obtain those results. The good, the bad, the ugly, you name it. So with that said, let's hope this video stays. Let's get into it. Let's start with my why. My why is simple. This right here is my backyard, and well, I don't want this backyard to look like this much longer. We recently bought a new home and moved into it, and when you have a new home built, you typically have to design a backyard, and if you don't know this, designing a backyard takes a lot of time. This is kind of what we're looking to do here, and it's a lot of money. So I was talking to my wife one day, what should we do in order to pay for this big construction, this big project? Because it is, once again, a lot of money. In fact, one of our first bids was $300,000. And well, since then, we've got that down quite a bit. Well, as most of you know, and she does too, I trade stocks. Primarily, I trade equities. So I swing trade equities. This is the 2024 United States Investing Championship. I did 45%. This year, currently, you can go to the website. I'm at 27%. That was the current results through May, but through June, right now I'm up about 30%. And what my wife had said was, why don't you just trade larger size? Now, the unfortunate thing is when you risk more, cool, you can have more reward, but when you also risk more, you risk losing more, and it could set us back. So how the heck are we going to pay for this backyard? Should we use our savings? Should we pull out from an investment account or take some from the equity that we have saved in our house? Well, I told her, I said, well, give me a few months and let me see what I can do trading a specific prop firm that is new. So the prop firm I'll talk about here momentarily, prop firms and what they are and how I did it. But as you can see here, I started in March 25th, Tuesday, and I started pretty small and I did okay trying out this strategy. In April, I did pretty good. I had one down day. It was a monster down day though. And I really didn't start picking up pace until later into May. And this is because I started picking up pace after I showed proof and I got proof of actual payout taking place. So this is May and this is currently the month of June. At the moment, I don't have any red days, but you know, like I'm going to have a red day eventually. And you can see here, this is the P&L curve started over here on that day, March, whatever it was, March 25th. And we are right over here now. So I've accumulated roughly about $100,000 in total profits here, but I've only been paid out so far $45,000. So we're going to walk you through I'm going to walk you through what a prop firm is, which prop firm it was that I'm talking about. I'm going to get into the brokerage portion of it. I'm going to talk about the various tools and stuff and kind of how I go about it to get you on the right side. Now, from my experience, when people trade at prop firms, you got to understand how a prop firm operates, right? They set up, right, these challenge accounts and people try to pay for their challenge, right? And then they try to get access to the possibility of trading for real money. Now, prop firms, they are going to be a losing business if everyone made money. The reason why there's so many prop firms opening up on every corner, right? Basically, so to speak. I call them the yogurt shops, right? There's a time and place where poke shops were popping up everywhere and yogurt shops were popping up everywhere. Now prop firms are popping up everywhere. And the reason is because there is a high lose rate, right? There's 95% of traders are going to fail those challenges and never see a payout. So if you want to become one of the 5% to actually get a payout, potentially even smaller amount there and make a decent amount, these are going to be the tools that I'm going to share with you that help me get on the right side of trade to avoid me from blowing up my accounts. Okay, so what is a prop firm? It's a trading firm, often called a proprietary trading firm. They're companies that trade financial instruments. They can trade stocks, foreign exchange, futures, cryptocurrencies. They use their own capital instead of client funds. The reason why we're using them is going to be able to access larger amounts of capital, right? Leverage. We get to trade larger positions with minimal risk, right? There's low personal financial risk. You get a structured evaluation process, which just kind of encourages disciplined trading. Now, I'm not going to walk through all the various type of prop firms. I'm going to share the one that I found to find success with, and I like it a lot. So I'm going to share that one. And then there's typically a profit sharing model where you get some of those funds. How does it work? Well, typically there is an evaluation phase, which we just recently discussed. So you go pick your prop firm out, which we'll talk about how that works. And then you typically go under an assessment period or a challenge where you have to prove your trading skills under their rules and their restrictions, pass it, and then you become available to trade to earn real money, despite it still being typically a simulated account. Then you have your profit distribution, and then you have the various risk controls like I previously stated. Now, there are some firms coming out with this thing called S2F, and this is straight to funding. So you can pay a larger fee, don't do any evaluation period, and jump right to straight to funding. Now, it's quite a bit more expensive to do this. This is the route that I took, but I took it also knowingly being more familiar with how these things work. So the prop firm that I chose to really kind of get behind here was Tradeify. Now, this is a very new prop firm. I can't talk to you about its, legitimacy via, accounting purposes and all their numbers behind the scene. But what I can say is this, they have a proven track record with me so far. When I asked for my payout, they did it the pretty much darn near same day, and they've been incredibly fast to pay me out. And now that I've received these payouts, $45,000 to be exact, well, minus their profit, so about $40,000 in payouts. I decided to say, yeah, I can get behind them as long as they keep this up, right? But remember, there's always risk hopping in prop firms. I've seen horror stories of other prop firms shutting down and people not getting paid out and so forth. So you got to be very careful with just hopping on board on any prop firm. But as of right now, at the time of this recording, which is June 24th, 2025, I've been having a very good experience with Tradeify. Now, when you pull up this website, you're going to have the option to pick various different plans. And like I said, you can go to these and see what they cost and see what the requirements are. Remember, requirements and things change. So I'm not going to go through all like how many contracts you can trade and all this good stuff. I'm going to show you exactly the ones that I did. So I did straight to sim funding. I went for the biggest account. I'll explain later, but I did 150K accounts and it's 729. However, I now become an affiliate with them. So if you want to, you can use FOM. It gives you the best discount, which I believe is 30% off. So it's about $500. And I bought 5 of those accounts. So it cost me a total of $2,500 for 5 150K accounts. And when you get your accounts all set up, they're going to look something like this, minus you're not going to have the numbers and the metrics here. These are the metrics right before my third payout, what it's sharing here. But you'll see your 5 accounts there, or 1 account, whatever you choose to do. And then when you open up one of those balances, you'll see like, okay, you'll start with 150,000. You'll see your total profit of wherever you stand. So that's kind of where I'm at the time of this recording. You'll see how long I've been trading it. I've been trading it for 61 days now, right here. And then you could see this one, I actually just recently received my payout on this, but they have various payout objectives, right? So they'll have a profit goal. To start out, typically you have to reach 9,000 on that 150K account. I'll show you that in a moment. But now once you progress through, you can have smaller profit objectives here. And then the days that you have to trade, right? 10 trading days to even qualify for a payout. And then you need to have a consistency of 20%. And a consistency basically just says that you can't have a day that's like, see how I had this $1,000 day here? Well, I had to get all the way to 5,150 in profit instead of the 3,000 goal to make it a 20% consistency. So they have the math and how that breaks down there for you. But I'll show you here. This is their current profit goal table and how it works. But I chose the $150,000. And then you have your payout goals. So in order to get a payout, you need to reach the goal 1, then 2, and then 3. So the first goal was to get my account to 9,000, which means what? I have to take the 150K account and bring it to 159,000. And then I qualify for my first payout of the 150 account, which is 3,000. Now 3,000 times 5, you do the math, right? 15,000. So because I copy traded, I was allowed to get a $15,000 payout, $15,000 payout on my very first one. Now remember, I only paid $2,500 to start, and out of the gate, my very first payout, I received the $15,000 payout, which 90% of that, which I think is like, what was it, 13,500 or something like that, because they do take a 90%, at least as the time of this recording. And you can see this going through the list, right? Here's the different payouts that I've done. I've only had 5 accounts, and I've been trading those ever since. I haven't blown up any account here. And you can see I had my first one was 41 days, 37, 37, 37, 36, right? This was my first payout of all 5 accounts, where you had 3,000, 3,000, 3,000, 3,000, and so down the list, right? These are just the payouts proof. You can see payout status is paid, and yes, I did get the money. Okay, now when you actually pick your account and you sign up, you got to choose a brokerage. The brokerage I chose to use is Tradeify, and honestly, I've tried some other ones like Project X and stuff like that. I just like Tradeify better. The DOM, which I'll show you here in a moment, it just is easier for me to utilize. It's a little bit less clunky as some of the other ones. That's what I use for now, at least, right? Once you pick your brokerage, by the way, they do this all here while you set it up. You'll have the option to pick Tradeify or Ninja or whatever you want, and then you'll be able to log in, right? You'll get all your credentials. It's pretty seamless. You'll launch the simulation, because that's what you're trading is, the simulation. And when you open up the account, it's going to look something like this. You'll have your DOM over here. This is where you can buy, exit, sell, market orders, or put orders into your DOM. And then you'll have your chart over here. Now, I'm going to show you just the exact setup that I use and what it is that I do. So first, I'm using a 30-second chart. So a lot of people might say, dude, that's crazy. Well, I'm not necessarily really trading based off of technical analysis like candles and so forth. That's not really what I'm doing. That's not what I did here. And I know a lot of people may come in here thinking that I'm going to share like some fair value gap ICT type strategy. This is far from that. I'm using a 30-second chart, and I'm watching basically the range of the candles for a part of that. But so if you go here and you click the chart, you can go down into seconds, and you can go ahead and click 30 seconds if you want to do exactly how I set it up. And then as far as the indicators go, you can click that button, explore the community indicators. I have a couple of them on. I do the Tiki opening range, the Tiki super trend, and then I also do the anchored volume weighted average price, or just the daily VWAP. Okay, so the Tiki opening range, I like to look at the first 30 seconds of the opening range. Now, this is a thing that I learned about opening ranges a long time ago, but what I learned not really recently, a couple years back, maybe a year or so ago, a trader by the name of Pax, who traded in the pit, was explaining why NQ pit traders, why they used the 30-second opening range and how they kind of approached that. So I've ever since have been putting the 30-second range on it, and it's been acting as a pretty good idea to quickly see where the market started the cash session at. And it could act as potential levels of resistance and supports, and gives you a good idea. When you're above it, you start to look to trade long. When it's below it, you can potentially look to trade short, and so forth. So the settings there to do this, right? It depends on your time zone. So I'm PST, so the market opens up at 6:30, right? So I do the start hour at 6, and then the minute I choose 29, and the duration I put at 0.5. Okay, this is on the 30-second chart. That will give you the accurate 30-second opening range. Now, if your time is at Eastern Standard Time, add plus 3 hours, right? So it'd be 6, 7, 8, 9, right? 9:29, and then your duration and so forth. Then the super trend is just a pretty useful tool to, like, when you're above the super trend, that's the trend is up, and you could potentially look for pullbacks to it and kind of follow along as the trend trades with that. It's really more of a visual, not necessarily a strategy, but I use a 7 period and the 3 multiplier on that 30-second time frame. And then the VWAP, if you can find a daily VWAP, awesome. I'd have this one, and you just have to adjust the anchor day pretty much every day. So if you can find one that automatically adjusts for just the daily cash market VWAP, I like to have that on my screen there too as well. Okay, the next thing that I want to just point out here on the brokerage account is setting up the DOM. I'm going to show you what I do. So if you click the settings on the DOM and the cogwheel over here, and then you click settings, it's going to bring up this screen. And I have a couple of orders, a couple of changes here where I click this one over here where I can do limit orders, left click, stop order, left click. Okay. And then over here is my estimated P and L. So when I execute into a trade, it shows me the estimated P and L on the screen. I like to see that. Some people get all, flustered by having that on their screen. That's really just a preference. I'm just sharing what I do. I like the left click stop order and then the left click over here because it allows me to just click on it, whether price is above or below the DOM, and let me set my orders up. And then you can see the next thing that I do with these 5 accounts is I copy trade them. So in order to copy trade on Tradeivate, you want to go ahead and click the caret to bring all your accounts down, and you go down to manage groups. When you go down to manage groups, you hit this little plus sign over here. That plus sign will allow you to type in a message or whatever name. So I just wrote funded for this group, and then you'll see all your accounts here, and you just slide them right over into there, and you hit save, and then make sure that you come back. And if you're going to copy trade all those accounts or multiple accounts, you go and make sure that you have this checked where it's saying that you're signed up to copy trade, right? You'll see the little check mark right here that you're doing. Now, when you're doing that, I want to be also clear that now, instead of trading just one contract in futures, you're going to be having to trade across multiple accounts. So you can't have the quantity be 1 while you have multiple accounts down here. If you were to trade one contract, you have to do it across 5 accounts. So you'd have to change the quantity to 5 to trade 1 per account. Does that make sense? Hopefully it does. If you want to trade 2 per account, then you'd have to bump that up to the 10. Okay, so that is the prop firm that I used, the accounts that I used, and the settings that I have set up and the indicators just for Tradeivate. I want to dive in a little bit deeper really quick for people that are completely new to the futures market. This, by the way, is a great way to learn the futures market in a simulated environment where, you could put in, whatever the cost is for whatever account you go with. And the most you risk losing is what you paid for that evaluation or that straight to funding account, versus you can get in a lot of trouble if you don't understand the futures market and you're trying to trade with your own personal funds and you haven't done your research yet. So this is quite an easy way to kind of get involved. Now, the futures market allows traders to buy and sell contracts that commit them to a transacted a specific asset at a set price and date in the hence futures, right? These standardized contracts clearly define asset details, quantity, and settlement conditions. We don't really necessarily, we're just day trading them. So we're in and out throughout the day. At the end of the day, we don't have any orders on. And when we start the day, there's typically no orders on there too as well, obviously, because you're starting the day fresh and so forth. Okay. Various future markets that there are, you can trade oil, gold, wheat, coffee, natural gas, stock indices, currencies, bonds, interest rates, cryptocurrencies, right? There's a lot of different markets to trade. I'm going to share with you the one that I prefer, and that is the MNQ. Now, there's something called the NQ, which is the NASDAQ 100 Index Mini, but the M in front of it stands for micro. So the micro, in my opinion, this is where a lot of people blow up accounts. They'll go right into trading minis, and then they'll blow up their accounts because they hit their drawdown limits very quickly, or they average too big in too fast. MNQ, I traded for 41 days, 41 trading days, which is, there's only 22 trading days in a month. So 2 months I traded to make $9,000 of profit, right? I copy traded that X5 accounts, 41 trading days of trading basically 1 to 3 MNQ contracts back and forth, scaling in and out to finally reach that level. And by doing so, it's going to build better habits starting very, very small, because the number one reason why people fail is themselves, right? Trading, so a lot of people say trading's difficult. Nah, trading is easy. The art of executing and entering and exiting, it's all easy. That's easy stuff to do. You're pressing buttons, okay? What makes it difficult is you, right? You are the one that makes it difficult. You want money, more money faster. You have to deal with greed. You have to deal with emotions. You have to deal with, is this the best time, and narratives and all this stuff. You are the one that's overcomplicating that, okay? So if you just start small and you get happy about very small wins, yeah, this process will keep you in the game longer, and you'll build better habits. So please, you go with larger accounts, make sure you're trading smaller amounts, even if it's the biggest account. Remember, I traded the largest account, 150K. And I traded MNQs, all right? Some traders will be like, oh, that's, lame. Well, the reality is I don't have $150,000 to lose in that account. I think the drawdown was like $6,000. So I really only have $6,000 to potentially lose. And you could burn up $6,000 incredibly quick by trading multiple NQ contracts. Now, the tick size is 50 cents per tick. So every tick that the NQ moves, which they're in 25-cent increments, it's worth 50 cents. Now, the MNQ, right, is a $22,000 product at the time of this recording. And as you can see, right, this right here, every little bar here in the DOM, right, is a tick, right? So you got 1 tick, 2 tick, 3 tick, 4 tick, right? 5 tick, and so forth. So each one of these ticks, you can see it goes from 0, 0 to 2.5 to 0.5 to 0.75 and back to 0, 0, right? That's $1, dollar of movement. And that's what? 4 ticks. Now each tick is 50 cents. So that means for every dollar that the NQ or the MNQ moves, the MNQ, for every dollar that the MNQ moves, that equals $2. All right. So if you trade one MNQ contract and it goes up $5, right? $5. So say, 421 to 426 up here somewhere. How much value are you going to be getting? Right. So it'd be 50 cents, 50 cents, 50 cents, 50 cents, 50 cents, 50 cents all the way through for $10. And that would be $20. 2 times $10 movement equals $20, okay? So that's just a quick rundown of MNQ and how much they are valued at, which you'll see that in the estimated P&L when you are trading. Okay, so that is the rundown of the setup, what futures market are really quickly, the product specifically that I'm trading. That's pretty much the only one I trade. I know some people that like to trade ES, or MES, which is the micro S&P 500. MNQ, basically, I'm trading the Magnificent 7 stocks, right? It's the NASDAQ 100, just to reiterate that. And that is pretty much ultimately the one that has, it's a very liquid product, and then it moves very quickly. And I think that pairs well with the tool that I'm going to share with you that keeps me on the right side of trade when it's most important. I do things called fading. So when things get way overhand to the downside, maybe I'll go long. When things get way overhand to the upside, maybe I'll fade it and go short. So I'm going to share with you the NYSE tick strategies that I use and this tool, just how powerful it is. Like this is, once you get some time behind the NYSE tick, and by the way, there's other ticks, right? You can look at the NASDAQ ticks, you can look at the Ruddy ticks and so forth. I use the NYSE tick. It's broad market. It's been working out for me, so I stick with it. It looks like this, right? The tick chart. Now the tick chart, you can pull up on TradingView. This is Thinkorswim. I use the 1 minute time frame. You can, if you want to use a different one, be my guest. It's the $ tick, right? You can pull it up places for free. Go to TradingView. You should be able to. Why did I do TIK? Why did I do TIR? Okay, it's a pretty useful tool, and I'll mark out what the levels are that I look at and how I use it. But more importantly, what it is. What is it? What's the NYSE tick? It's a chart. It's a market indicator showing, and this is only for the U.S. markets. I think this is just for U.S. markets. So it's showing you the real-time difference between the number of stocks trading on an uptick, prices increasing, and those that are trading on a downtick, price decreasing on the New York Stock Exchange, right? New York Stock Exchange and NYSE, okay? So there's a couple key components here. You get positive readings, more stocks are rising. Negative readings, more stocks are following. I'm going to share with you how I use it in the ways that I use it, but one of the ways to use it is by looking at extreme readings, whether it's overbought and or oversold, where you can potentially catch very quick reversals. The next thing that I like to use is spotting divergences, where you indicating that the trend might be weakening, but you see the internal strengthening, or you see internal strengthening, and yet you see the NYSE tick weakening, and that could be a negative divergence. Now, the analogy that I use for this tick chart is think of a bunch of people on a boat, right? You're traveling around on a boat and you have all these people because they hear something's over here, right? You get a new, oh, there's a shark in the water. So everyone runs to this side of the boat. And while you have all this weight piled up, the boat starts to kind of turn over. And the more that we stay here and the more people that come, you risk the potential of capsizing the boat. So what happens typically? Well, when you get to this area, you typically want to level out the boat and run to the other side. And that is the analogy analogy that I use for these extended readings. So every day I have a alert set automatically at minus 950 and plus 950. Okay. These are considered more extreme readings. Now, I don't use this at the beginnings of the trading session. So in the first 15 minutes, don't really care about it. The last 15 minutes, I don't really care about it because you get a lot more volume, you get gap ups, you get gap downs over here, and so forth. So if you want to find a way to integrate it into your process, you can do so by using other tools, which we'll talk about. But that's just looking at tick alone. I don't really like looking at those time frames. Then when you start to see actual real extreme readings into the thousands, this right there is telling you that, hey, this boat, it's about to flip over, right? You typically get in the market some strong selling, and then all of a sudden everyone's all super bearish, and that's the time when you could potentially start to layer in a couple MNQ contracts and catch a pretty quick bounce. So let me give you some examples of what that might look like. So over here, this was on, I believe, May 29th. I know it's small, but this is the chart on May 29th, and you can see I hit an alert, midway into the day over here is 8:30 Pacific Standard Time, and we finally got this tick reading down here at the 800-ish reading, okay? So we didn't quite get fully extended, but being that the entire day we were kind of in this tight range, I was watching this level down here and we started to break, having a lower break. So I thought, okay, now that we broke, maybe we can go lower, but there might be some sort of possibility to play a quick bounce. So over here, right, you can see the 30-second chart. This is the same time frame, the 30-second chart on my broker, and you can see that I executed basically as we broke into this low minus 800 reading to see if we can get a quick scalp to the upside. Now this quick scalp, it was about probably one MNQ contract, and it was good for what, maybe 10, 20 points, something like that, very, very quickly. But look at, if I wasn't paying attention to this tick chart, how would I have known to enter down here versus, well, right here, maybe right here, maybe right here? And this is the areas where people tend to blow up. They'll be like, hey, the market's been doing good. Oh, we got a pullback. Oh, okay, I'm going to go along if it shows strength. Oh, it didn't show strength. Oh, you're going to keep dropping, or the layer into it. So this is what really helps you execute at a better area. And or another way is maybe you were long, or maybe you were shorting up here for some whatever reason. You were short and the market started selling off. Well, you may have started to exit the position when we started reaching down to these lower tick readings to just capture more of the momentum here and not wait to see what happens after the fact for a new setup. So that one resulted in a little bit of a bounce. Now, also shortly thereafter, about 30 minutes later, because I also alerted this one out, right? I don't always alert this stuff out. It just happened to be the example that I'm using. Now, at 8:57 a.m., we started to get another pretty severe reading. And this is now when you want to pay very close attention to how you layer in, because just because we're getting a low reading here doesn't mean that we're going to bounce right away. You want to see, hey, is it going to draw down lower? Is it going to hold down here? And so forth. So you want to start typically pretty small. And as you can see, if we zoom in, it was that minus 1,000 reading. Okay, not only do we get volatility here, volatility is waking back up. And as the market was getting these minus 1,000 readings down here, I always keep an eye on some other charts, right? Here's the SPY at that same exact time. You could see going into 9 o'clock. Where were we pulling into, right? We were pulling into actually last year's closing price and back to that 5D DMA. You could see the market sold off pretty hard and so forth. And that opened up the door for a nice execution. So over here, you can see the tick bar, right? This is just showing you in a different way. I'll show you how this works. But we had that minus 1,000 reading at that specific time. You can see we got it right about here. The market started to press a little bit lower, and then boom, you found a massive, massive bounce back recovery. Everyone ran to the other side of the boat. Does that make sense? Hopefully it does. So this is what I mean. You don't want to just go full bore too hard and too fast. If the candles are expanding and you're starting to see large moves, you can quickly catch quick moves back for very short pops. This is just a fading strategy. It's not to be held for the all-time low bottom, right? For me specifically, I probably played this right at around here, layered in a little bit more, and then maybe sold off right at around these areas when we started to bounce back, right? That's all I do. And if you're thinking of like, well, what's your risk to reward? I'm going to leave that open for you, but for these type of fade trades, because they're higher win rates, typically your risk is bigger than your reward. So maybe it'd be a 2 risk to 1 reward, and it gives you space to snap back because you're entering at an extreme level, right? And maybe you can build into it and then you could come back in and so forth. But that would be my ideal because you're fading a weak move, right? Which typically pursues a higher win rate, which, by the way, this strategy is basically, I'm at an 80% win rate for since I've started, which is in late March, and now it's June. Okay. There's another way that I like to use this, and this is using it as a divergence. So over here on this specific analogy, you can see I'm kind of up for the day. I'm copy trading those 5 accounts, and you can see the NQ on 6/11 on this 30-second time frame. We're below the opening range, right? We're below the super trend here. We hit a low, we hit another low, and then over here you can see the tick charts kind of popping through. And during that same time, we had a low but a higher low. So you can see I'm going to highlight them here. And what does that mean? Well, we had a negative reading over here that probably produced a nice little pop here to trade, but then the market started selling off, and we didn't quite get down to a very bearish reading. However, we saw a big flush. That to me is a positive divergence, and I would 100% execute into this for the possibility for a pop. Now, am I going to trade it all the way up here? No, probably not. But if I can catch some of this move and scalp out some of those trades, maybe I can leave a couple runners on. And as we pull back up into this higher range, maybe that'd be a good area to start to reduce some of that position or get out in its entirety. Now, if you don't want to have a tick chart on this side and this over here, and you use something like Thinkorswim or TradingView, I think you can use a comparison chart, a study, a lower study, and you can go ahead and change the comparison style to bar, and then you can do the secondary security as a tick chart, right? The NYSE tick chart here, and hit OK. And what it'll look like is this. This was actually today's tick chart. So you get the tick chart down here, right? You get your minus 500, 1,000 reading over here, right? You can scrunch it down and see the minus 1,000. And you can see NQ up here, or ES, whatever it is that you choose to trade. But for example, like you can see here, we basically didn't do any really extreme readings today overall, other than just kind of the start of the trading session and then a minus 700 reading over here. But over here, we put in a high and we put in a lower high while the NQ kept on pressing higher. You can see there was a divergence that actually played more to the downside. So I like to look at extreme fades as one strategy. Then I like to look at divergences. And then also, we mentioned quickly some key levels to obviously watch out for as well. So you can see on this one as well is a different use of the tick chart, because people get creative with this stuff. You can put on moving averages on tick charts. You can also put in an RSI. So for example, right here, right, I have a RSI of, what is this, the settings here? 725, sorry, 775.25. So that means overbought would be 75, oversold would be 25, and then over here on the main setting is a 7 value. And you could see at this time, we were getting good volatility. We're getting multiple minus 1,000 readings, but over here, we didn't produce one, but yet the market was actually selling off. We were seeing some larger range candles come in into, actually see that little blue line right there? That was, I believe, that was either the entry or the upper opening range. I can't quite remember, but pay attention to what the RSI was. The RSI moved into an oversold condition, and in that area it led to a nice little pop there. Okay, so you can utilize an RSI if you'd like to, and you can do divergences and then also extreme readings. Now, something very important about all of this, because people are going to see it and be like, awesome. The problem here is, when does this actually work the best? And that's when it comes into understanding market conditions. This works the best in high volatility environments. So when there's not a lot of volatility, you're not going to get extreme readings to the upside or downside very frequently. It might come once a day. It might not even come throughout the entire trading session. So you might have to use the tick chart differently as where it was for that day to be high reading, or where the RSI might be, or if you spot divergences. So when this works the best is terms of high volatility. Now, I'm going to show you exactly how I determine when I start to day trade this strategy more frequently. This is the chart of the VIX, and the VIX is highlighting some gray boxes, and these gray boxes are highlighting the times that we're in what's called negative gamma territory, okay? Negative gamma territory is, this is incredible to, a lot of different prop firm traders, they just don't get this. So you'll see a lot of different prop firm traders, online, influencers and so forth. They have no idea about this stuff. And then they'll say stuff like, oh, the price action was trash. It's not, my strategy, this, that. But they just don't understand that their strategy works better too for day trading in high volatile environments. Day trading requires volatility. If you want to make money, you need volatility for that day. So the S&P 500, there's something called the flip line. And when we're below it, it turns all green down here. When we're above it, it's white. When it's white like this, you're typically going to have less amounts of day trading activity to take place in the MNQ, right? You're not going to get huge swings. Sometimes, right, you'll have a news drop, right? You'll have the president say something, whatever the case is. But these times, holy moly, you'll get a lot more responsive actions. You'll get more extreme readings because volatility is higher in these environments. Now, I'll share with you how you can get the gamma flip line and so forth and how you can track it. But most important to know is that when we are below the flip line, dealers, they sell into selling, they buy into buying, volatility increases. As you can clearly see here, we fell below the flip line, boom, right? We fell below the flip line, boom, right here, boom, boom, okay? And then when we're out of it, you can see what happens. It goes down, it goes down, it goes down, right? It goes down, it goes down, it goes down, it went down, right? That is being in a positive gamma environment. And that's typically when it's working better for day trading. Or sorry, for swing trading. Now, if you want that indicator or this to track this and track the gamma flip line and a bunch of other cool, useful tools, I do post this into my Discord basically every morning. I make free videos too on YouTube, but it is on gammalab.io. You can use code MSD50 and get 50% off your first month. It's only $14.99 a month for all of that stuff. Actually, it's really inexpensive and it's a great product. For 15 bucks a month, you can't beat it, or $7, right, for the first month or whatever it is. Okay, but now I want to get into some more important tools. These are just the tools that I've used and been using, right? So first off, the main one there was the tick. That helped me be on the right side of trade when I need to be. But these are some other tools that you can use in unison to help you get a higher win rate, to make you more efficient on entries and so forth. And these tools, one is right back to Gamma Lab. I like to use gamma exposure levels. So for example, net gamma, you can see in short, right? If you want to read into what gamma is and what gamma exposure is, be my guest, go ahead and do it. In short, these levels, right, can act as potential resistance and potential support. Now, I really pay attention to just SPX, right? The biggest product out there, the big dog SPX. And even if SPX, right? Even if I'm not trading it, but price for the S&P 500 comes up to a big level like this, there's a probability that and if it gets rejected, the NQ is going to get rejected too, because they do share the similarities and a strong correlation. But for example, in today's trading session, which is June 24th, 6,100 has been our level that traders are focused on. And you can see price action today flowed all the way right into 6,100 today. And then what? It got actually rejected. It can typically act as a potential rejection level and or a place where price gets pinned around, right? If you overshoot it, there's a high probability that you pull right back into it if traders don't start reaching out further. So that is a very critical element there, is looking at the net gamma big levels like the call wall or the next local and or support and or resistance. But then in Gamma Labs, you can also go into net gamma 1 DTE, and that I look at before the market opens up because it can give you clues. So in the Discord, right, in my Patreon Discord, and this is not one of the benefits, but I do post it in the mornings of doing it. But you can see I post the 1 DTE levels, right? So for example, this trading day was, I think the 23rd, and I kind of highlight the levels out. These is where traders were focused in at. You can see there was a lot of activity taking place lower here and a lot of activity taking place up higher. And price, right, if you're on the right side of trade, you can trade up into and around these levels or use those levels as action points if price were to reach up into it. So this is not just looking at some, gap fill or some aftermarket session high or anything like that. This is utilizing data, actual data of where traders are reaching to and where a lot of focus is at. So I love the 1 DTE levels. I love the net gamma levels, and I look at them every single morning if I'm going to be executing trades. Now, another thing that I like to use is a tool called Market Net Flow. And this is big because you might be saying, well, how would I have known to trade all the way up, right? Or how would I have known to at least buy some pullbacks and trade, on the pullbacks to the upside? Well, Market Net Flow is a very useful tool for that. This is from Tradeify. You can also, in the Discord, in the query channel, I have the option so you can type in a command to get this chart. It doesn't show convergence down here, but sometimes I share it. It'll show a different indicator called momentum. But you'll get a chart that looks like this. This is a full day's chart, and you'll have a green line, a red line. The white line is just the price of the SPY. And this is looking at the cumulative net premiums of calls for the day and puts. And you can just watch how these lines are working. And as you can see, right, for a day that this market went basically up, what do you notice here? The green line was trading up, while the red line was basically flat to slowly going up. So we had a divergence between the calls and the puts. This is a bullish divergence. And when SPY moves with that, you get positive convergence. And you can see the price of the SPY was saying, hey, not the time to short, but if we get pullbacks, look to buy the pullbacks to head higher. Now, if the red line, right, if the red line was up here like this and the green line was down here like this, and this whole thing was lit up red, I mean, redraw this was all lit up red down here. Guess what? The SPY is going to have a very difficult time trying to move higher and higher, or the NQ, because the flow of the market is telling you that it's rather bearish, and that would actually present more potential of a trend day down or kind of a flat to neutral day. So this will help me be on the right side of trade when it matters. The tick chart helps me execute on overextended, oversold, overbought levels. Okay. And then the gamma levels can act as potential levels of support and resistance that I could trade into. They can be action levels or levels of focus that maybe a runner is going to go into. The last element that you probably see me post a lot about is expected moves. And the expected moves are, right, if you think in terms of a distribution curve, right, 68% of the time you typically go for these levels. This was today. We actually started up here and we broke through the daily expectations. We're outside of the weekly expectations, but you can see the market's pulling back. There's actually a high probability that we pull right back into the upper weekly implied move, and we could potentially doodle there for the rest of the week, right? Today's Tuesday, right? Today's Tuesday. We got all the way till Friday, and we knew this level was what the market expected on Saturday of last week. And I'm saying here that there's a high probability that we come right back in or doodle around this level for the remainder of the week, right? Which is, it just comes with experience seeing these things. But expected moves, if you are in the Discord, right? I have a video on how you can make your own expected moves or pull them up on Thinkorswim or other apps. But in the Discord, I just created the AstroBot. You can type in the eyeball range command. You can get the upper or lower levels for whatever it is that you're trading. I share futures expected moves, but the AstroBot does not pull futures because the API doesn't allow for pulling futures, but you can use equities and ETFs. And, you know, if you were trading like the NASDAQ, right, you can potentially look at the Qs, daily expected move, if you don't want to look at the futures exactly. Okay, so those are the things that I use. So the final thoughts here, the most important thing, okay, the most important thing is if you are trading just to make money, you need a better reason that can keep you grounded. And speaking of grounded, right, it was my backyard, right? I told my wife, I was like, let me think of a way that, hey, we can come up with some extra additional money so we don't need to pull too much out of our savings to do this, because it's a big project and it's something that we really wanted. Okay, so have a very good reasoning and some sort of accountability partner or something that can keep you grounded, because the next step there is to make sure that you're trading a small size. So I use the MNQ, and that's going to keep you in the game longer, right? So if you're trading smaller, be prepared. Like I did, I traded, like if you want to do this, right? Are you okay with trading 41 trading days, 2 months without seeing any benefit from it? If I told you now, oh, well, now I've gotten 3 payouts, right? Because you can, once you get comfortable, once you get more experience trading smaller, you can start getting, and you get more comfortable with the tick chart, with gamma levels, with expected moves, with flow, and that kind of stuff. You can scale it up to maybe 2 MNQs to 7 MNQs, or 10 MNQs, which is 1 mini, to 20 MNQs, right? Something, you know, a lot larger, which is kind of where I'm getting to right now as I've been, you know, started now that I'm working on my 4th payout, which can bring me from 45,000. Get this is crazy. So I'm 9 days away now from a potential payout, minimum 9 more. I have 10 trading days. I just did 1, so 9 trading days. I've already got paid 45 in payouts, right? My next payout could be 17.5 because it increases a little bit on the last payout. But then get this, then if I get there, they might move me to live, which means that they're going to pay me an additional $17,500 out and move $20,000 to a live account, bringing me up to about $80,000 in payouts and potentially the next, you know, 15 days or so. So once again, have a good reason why, okay? Have a good reason why, and then trade small, get used to it, have some small wins. Don't go crazy, because trust me, you're the one that's going to make this difficult. These tools I used, I showed you results. You can do this too if you're patient. If you don't like trading in a positive gamma environment, wait until it's negative. For me, I actually swing trade a lot more in positive gamma than I do in, obviously, negative. So in negative gamma, you'll see me day trading much more. Over here, you'll probably hear me impose a swing trading and doing more position size trading. All right, everybody. Hope that helps. Hope it gives you some good insight. If you have any questions, you can leave them in the comments. See you later.